Good evening, everyone. So, before I begin, let me tell you a very real life scenario. Now, imagine this: a startup has just closed a funding round, term sheets are signed, investors have committed, everything looks very perfect. And then suddenly a war breaks out. Suddenly, shipping routes are blocked, payments are delayed, costs are increasing overnight. The investor calls and says, "We are re-evaluating the deal." The founder says, "But we have already signed." The investor replies that, "Yes, but your business is no longer what you represented." Now, here's the real question: was the startup wrong in this case, or was the contract weak? Because in most cases, it is not the business that fails, it is the documentation that fails the business. And that is exactly what we are discussing today: the war clauses, valuation, deal structuring, and most importantly, how a boilerplate clause like force majeure can decide the survival of your startup. Now, here we are not talking in theory today. We are talking exactly in the context of the ongoing Iran war. Now, the war has impacted the oil prices, the supply chains, the currency stability, and most importantly, the investor confidence. So, today, legal drafting is not something that's just a legal routine, it's a strategic risk management. So traditionally, there were these, very standard statements that were made by the founders to the investors. For example, our financials are accurate. There is no undisclosed liability. We are compliant with all the laws. But today, the nature of these clauses is changing because the business environment itself has changed. Now, because the business environment has changed, we are now operating in a world where geopolitical risks are very real. Wars have impacted businesses directly. So, a war clause are no longer limited to very internal matters, they now extend to external risk exposure. So, now let me break this down. First of all, business continuity despite geopolitical risk. Now, investors want an assurance that even if there is a war or a geopolitical disruption, your business can still function. Now, let me give you one example. There is a startup which is heavily dependent on suppliers from a region affected by the conflict. Now, the investor is going to ask you that, do you have an alternate supplier? Do you have any contingency plans? Because if the answer is no, in this case, the business is very fragile. And this also affects investment decisions. The second aspect: no material adverse effect due to war. Now this is becoming a very sensitive representation because today war can directly impact your revenue, operations, and market access. For example, a company has major clients in Middle East. Now due to war, your payments are delayed, your contracts are suspended, and if the founder has stated there is no material adverse effect on the business, this statement becomes highly inaccurate, and that also triggers legal consequences. Third, the disclosure of exposure to conflict zone. Now this is something that's very critical today because investors want complete transparency on where your customers are located, where your suppliers are based, and on which market are you dependent on, because exposure to high risk regions always affects your valuation and risk assessment. So the new reality, let me highlight the most important shift for you. War risk disclosure is now become a very standard clause in term sheets. Earlier, term sheets were only focused on valuation, equity, control rights, but today they are also focusing on risk exposure. Now, investors are asking questions like, are you dependent on conflict prone regions? Will your revenue be impacted by geopolitical instability? Do you have a risk or a mitigation strategy? Now, the role of lawyers here is changing insignificantly. Is changing significantly, sorry. Because now you're not just drafting clauses, you are also assessing the business risk. Because if war clauses are drafted very vaguely, they can expose the founders to liability, they can lead to indemnity claims, they can also trigger disputes. But if they are drafted properly, they can clearly allocate the risk, protect both the parties, and avoid future litigation. Now, let's talk about something that is very standard these days, the force majeure clause. I don't know how, we'll just keep it because people want PPT. I'm sorry, I forgot to switch it on while I started talking. So let's talk about the force majeure clause. Most lawyers, you just treat it as a standard clause. I mean, until COVID, force majeure clause was a clause which most lawyers didn't even read. You just copy pasted it and that's it. So it's basically known as a boilerplate clause. Okay, boilerplate clause are all your standard clauses, which is there. Okay, just for the sake of it. Common hai, copy paste kar lo, ho jayega. But let's be honest, in most agreements, yes, it is copied, pasted, and it is barely negotiated. Now it comes at the end of the contract, and because of that, most of the people think that this is something that is never used. But today, it has become one of the most litigated and the most misunderstood clause. Why? Now, before that, let's go a bit, before and understand a few other concepts. That is your material adverse effect clause or your MEA. Now, at its core, an MEA, it allows any investor to say, yeah, that a material adverse clause effect clause, it allows any investor to basically say that something significant has changed, and because of that, this deal no longer makes a sense as it was in the same way. Now, traditionally, MEA clauses were drafted broadly and they covered things like, major financial losses, regulatory changes, business disruptions. But today there is a very clear shift. MEA investors are now explicitly including war, geopolitical escalations as MEA triggers. Why? Because Iran war has shown us one thing very clearly, that external events can fundamentally change business realities overnight. Let me just explain it to you in a very simple. Okay, sorry. So let me explain it to you with a very simple and practical example. Now, an investor agrees to invest, let's say, 10 crores. And at the time of signing, the startup had stable supply chains, predictable revenue, it had strong projections. But before the money was actually invested, the war escalates. So now what happens? Supply chains are disrupted, cost has increased, customers have delayed payments. So the investor steps back and says this is a material adverse effect. And because the material adverse clause allows it, the investor can now renegotiate the valuation. He can delay the investment or even withdraw from the deal. Here is where it becomes very interesting from a very legal point of view. In practice, deals today are not always being cancelled outright, but they are definitely being repriced, they are definitely being paused. In fact, there is already a great growing gap between sellers expecting pre-war valuations and buyers factoring in war-related risk such as IMAA. Now, what we are seeing is a huge shift in negotiation. Let me give you another realistic scenario. Now, a startup was valued at 100 crores before the war. Now, post war, the investor says that we are still interested, but now the valuation is 70 crores. Why is it? Because the risk has increased, the predictability has reduced, future cash flows are very uncertain. And this is completely aligned with what we are seeing globally today. The Iran war has completely disrupted supply chains, increased cost, made investors far more cautious. Here is another legal takeaway. People always assume that MEA clauses are easy to invoke. They are not. Courts generally interpret them in a very strict manner. So short term disruptions are usually not enough. The impact must be significant and long term. So, what are investors doing instead? They are becoming smarter in drafting. Instead of vague MEA clauses, they are using specific triggers. For example, loss of key customers, closure of key markets, disruption of specific supply routes. So, today, MAE, is no longer just a legal clause, it is a negotiation tool. It gives investors flexibility in certain cases, but you need to remember that in today's world, valuation is not something that is fixed. Deals are not final until money is deployed, and your MAE clauses are the bridge between uncertainty and negotiation power. Now, under the legal, okay, I lost it. Yeah. So, under the Contract Act, your force majeure usually operates through Section 32, that is your contingent contracts, and Section 56, which is doctrine of frustration. Now, here is a small distinction that one needs to remember, that if your force majeure is written in your contract, Section 32 is what applies. If it is not written, then Section 56 applies. Now, courts in India have consistently held that mere hardship is not enough and mere increase in cost is not enough. Your performance needs to be impossible, not just difficult. For example, a company says our costs have increased due to war. That is not force majeure. A company says we cannot import goods because shipping routes are blocked due to conflict. Now, this is something that can amount to force majeure. A startup says that our Middle East clients are not paying due to banking restrictions and sanctions. Now, this becomes a very gray area, which completely depends on your legal drafting. So the words which you use become very important. So that's why just copy pasting the force majeure clause is not going to work any further. Now let's move on to one of the most important aspects of this discussion, your startup valuation. Because at the end of the day, every legal clause we discuss, your war clause, your MOA, your force majeure, ultimately impacts the valuation. And today we are seeing a complete clear shift. Before war, the startup ecosystem was driven by only one thing, that was growth. Founders were being rewarded for scaling fast, acquiring users, expanding aggressively. Profitability was something that was optional. But today the mindset has changed. The investors are no longer asking that how fast are you growing. They are asking how long can you survive, because today the focus has shifted to resilience, sustainability, and profitability over hyper growth. Let me simplify it for you. Now, burning cash to grow was something that was acceptable. We have seen a lot of startups in the past who have burnt cash like anything for the purpose of capturing the market. Let's say, for example, a lot of cash was burnt earlier, and that was a trend which was acceptable and which also resulted in a lot of bubble valuation. I'm sorry, somebody needs to say it out loud. That is what led to bubble valuation. And once that bubble burst, we had a lot of companies which also went bankrupt. Not taking names of certain companies, certain startups, but I'm sure anybody who follows the news knows all these details. Okay. Now, burning cash without visibility is a red flag today. Let's say 10 years ago, 15 years ago, this was normal because you had to acquire the market, you had to, make your visibility known. तब सब चलता था, आज नहीं चलेगा. Today it's a huge red flag. So today investors are far more cautious. They want clarity. So first, cash runway clarity. Okay, let's talk about that. They want to know how many months can the startup survive without any additional funding. Second, they want risk adjusted projections. Okay, earlier projections were very optimistic. Now they usually factor in the supply chain distribution disruptions. What are your currency fluctuations? How is that impacting you? How is the market instability impacting you? So now projections are not something that is longest best case scenarios, which it was earlier. Today they are stress tested scenarios. Now let's understand how exactly is the war impacting the valuation. So let's talk about the first impact, which is increased discount rates. Now, when risk increases, investors demand higher returns, and higher returns expectation means higher discount rate. Second, there is reduced certainty of future cash flows. So, revenue is not something that is any longer predictable. Client delays payments, contracts get paused, markets become unstable. It's all normal today. Third, there are sector specific shocks. Now, let us break this down. Logistics startup, they are facing higher fuel cost. There are delivery delays. There are energy dependent businesses, for example cooking, food, restaurant industry is completely energy dependent. They are directly impacted by the oil price fluctuation. SaaS startups with global clients, they are facing payment delays, they are facing currency risk, geopolitical exposures, etc. So different sectors are impacted in different ways, but the outcome is same. There is increased uncertainty. Now, what is the result of all this? There are down rounds, which means the startups are raising fund at a lower valuation than before. Now, this is a very sensitive situation because it impacts the founder equity, employee morale, market perception. Now, let's break this down technically, but in a very simple way. Valuation often uses discounted cash flow method, which basically means what are your future earnings worth today. Now, here the key concept is risk determines your discount rate. Now, before war, let's take for example, a startup had a discount rate of 12%, meaning the investors were relatively comfortable with the risk. Now, due to war, risk has increased significantly. So the discount rate becomes 18 to 22%. Now, what exactly happens? Even if your future profit remains the same, their present value drops. Let me say that again because it is very important. Same business, same projections, but higher risk, they lead to lower valuation. So the final outcome is a significant drop in enterprise value. And this is exactly what we are seeing in the market today, unfortunately. So let me just summarize everything in one simple line. Before the war, the valuation was driven by optimism. Today, valuation is driven by risk. And this is where law becomes very critical because contracts define risk and risk defines valuation. So if your legal structuring is something that is weak, your valuation will suffer. But if your risk is something that's addressed properly, your startup becomes investable and even in uncertain times. Now, let's again go back to the Force Major clause and why it is no longer a boilerplate. Because today, wars impact your logistics, payments, your technology infrastructure, your data flows. So, Force Major now directly affects your revenue, contracts, valuation. So, I want to talk about how. Hello. Okay, let's continue with the force majeure clause. As I said, let's go ahead with one of the most landmark cases. That is Satyabrata Ghosh versus Mugniram Bangur and Company. Here, the Supreme Court had held that mere hardship, convenience, or commercial difficulty, it does not amount to frustration of contract. For frustration to apply, performance has to be impossible and not just unprofitable. And this principle is extremely relevant today because businesses are invoking force majeure because the cost has become very difficult to manage. Let's talk about the most important part. I'll come back to these details later. Let's talk about the most important part on the application and the legal drafting. Okay, so let's talk about how you're going to draft. So, if you are drafting a force majeure clause, you definitely cannot rely on very generic language. You have to have very specifically mentioned about your war, your armed conflicts, and your geopolitical tensions. It should also include your blockade of trade routes, supply chain disruption, but that is not enough. In today's context, you need to go further and also include economic sanctions, currency volatility, banking restrictions, and also government imposed trade barriers because these are the real challenges that one faces. You can also include operational clauses like notice requirement that the party must inform within a very specific time, the mitigation obligation, how parties must try alternate means. You can talk about suspension versus termination, clarify whether the contract will pause or whether the contract will end. You can also have renegotiation clause, which will allow the parties to revisit commercial terms. Now, I leave you with this thought that force majeure is no longer a boilerplate. It is a risk management tool today. And if your clause is somewhat weak, and if your contract becomes weak, then your business is exposed. Okay. Now, most clauses, they say that act of war, natural disaster, that is not something that's sufficient today. You must specifically include war and armed conflict, economic sanctions, trade route disruption, supply chain breakdown, uh, currency, volatility, your government excuses, etc. So your force majeure, if it's a very vague clause, it is very dangerous. It has to be specific. It needs to add all the details. So we just spoke about force majeure. Now let's talk about fundraising. How are you going to raise funds? Now everything that I spoke about may seem scary, but it's not so. You can still raise funds. So the biggest difference or the biggest shift that we are saying is that despite all the conditions, we have fundraising that is still happening, but it is slower and people are far more cautious. So now, considering the war, the first impact is there are slower deal cycles. Earlier, the deals were closed in weeks. Today, they take months because investors are taking, time to assess risk from all sides. Second, there is increased due diligence. Investors are going deeper ever than before. They're asking questions like where are your customers located, what is your exposure to high risk region, how stable is your supply chain. Third is there are lower valuations because uncertainty has increased and investors are honestly not willing to pay a premium. So, what exactly are your investors pricing in? Two major risks. First is political risk, that is, will war escalate? Will market shut down? And second is your currency risk. Will exchange rates fluctuate? Will payments be delayed or reduced? So, valuation today includes a risk discount for uncertainty. So let's go ahead to see on how deals are changing themselves, because this is where your legal strategy becomes very critical. So in the first shift, we see that there is more use of convertible instruments. Instead of fixing valuation today, investors are preferring flexibility. So they prefer to opt for convertible notes or your safe agreements instead of equity, which was earlier, because valuation today is very uncertain. So they defer valuation for a later stage. Second shift is milestone based funding. Instead of giving full capital upfront, investors release funds in stages. For example, 2 crores now, 3 crores after revenue targets are met. Now this also reduces the investors risk. Third stage is there is stronger liquidation preference. That is to ensure that, god forbid, if the startup fails, the investors get their money first. Fourth shift, there are stronger anti-dilution clauses. Now, if the startup raises funds later at a lower valuation, the investors are protected. And this is very relevant today because down rounds are becoming very common. Now, if you look at all these changes together, you will notice one common pattern. Risk is shifting from investors to founders. And this is exactly where lawyers play a crucial role, because your job is to balance this risk, your job is to negotiate fair terms, your job is to protect long term interest of the founder. So remember, today's environment, funding is not just about raising money, it is also about structuring risk. And the better your legal structuring, the stronger your startup becomes. So let's connect back on valuation. What happens when your contracts are weak? Your revenues become uncertain, your risk increases, your discount rate increases. And then what happened? A poorly drafted force majeure clause can cause, direct destruction of the valuation. Now, think about it. If due to war, you cannot deliver your services, your customers lose trust, your brand reputation suffers, goodwill reduces, and your goodwill is a huge part of valuation. Also, IP enforcement becomes very difficult in conflict regions, okay? Because their survival is more important than growth. And because IP enforcement is very difficult in conflict region, it also leads to more cases of counterfeiting and more infringement. So your intangible assets are also at risk. Now, a lot of startups fail due to funding issues, market competition. But in reality, many startups fail because the risks were not documented properly. So the next time you are drafting a contract, do not treat force majeure as a boilerplate. Do not treat war clauses casually, because in today's world, the strength of your startup lies as much as in your legal drafting as in your business model. So this was the end of the session of impact of war on startups and funding. We'll be having more such sessions, so do follow me and do subscribe to the channel. Thank you so much.